Market is ripping higher today following news that Trump will exclude some countries from reciprocal tariffs and that these tariffs on April 2nd are going to be more targeted than just a blanket approach as we were expecting previously. This follows news on Friday where Trump said he would be flexible on tariffs overall. So it's really creating a bit of a light on tariffs where it was kind of a dark cloud before. In an oversimplistic way to explain it, that's why markets are moving higher. But you also had some economic data that came out today. And there's really a core reason why markets like this. And it doesn't have to do with inflation. It actually has to do with the economy. And I do have to say, for anyone that is a big bull out there, this recovery looks really good. Today's price action is a huge step in the right direction. Although I think there's still a lot of uncertainty, the odds of a recession are higher than most people think. You gotta love the gap up, support, and bounce at the 200-day moving average. We'll talk about that more in just a few moments. But first, we have to get into all of your breaking news today for markets. Okay, so the big news that came out this morning goes like this. Quote, Trump has said the tariffs are aimed at any country that imposes duties on U.S. imports. But the Wall Street Journal reported the tariffs are expected to be more narrow in scope and will likely exclude some industry-specific duties. Citing an administration official, Trump will also exclude some nations from the tariffs, Bloomberg News reported. Both the Wall Street Journal and Bloomberg News reports noted that the situation remains fluid and that plans could change. Now, this comes after Friday. Trump said that he could be flexible for his reciprocal tariff plan. I will highlight through all of this, there's still not a lot of certainty. Who's going to be tariffed? What's going to be tariffed? How much is it going to be tariffed? We just don't have a lot of details still, but it's starting to sway in a more positive direction. And that's what Wall Street likes after this 10% correction. But no way, shape, or form means that you are in the clear, new all-time highs, time to go all in on markets again. That is not, and I repeat, that is not what today is about. I mean, this morning, Donald Trump comes out and says that he is announcing, as of today, that the United States of America will be putting what is known as a secondary tariff on the country of Venezuela, for numerous reasons, including the fact that Venezuela has purposefully and decisively sent to the United States uncover tens of thousands of high-level and other criminals, many of whom are murderers and people of a very violent nature. Among the gangs they sent to the United States is Tren de Aragua, which has been given the designation of foreign terrorist organization. We are in the process of returning them to Venezuela. It is a big task. In addition, Venezuela has been very hostile to the United States and the freedoms which we espouse. Therefore, any country that purchases oil and or gas from Venezuela will be forced to pay a tariff of 25% to the United States on any trade they do with our country. All documentation will be signed and registered, and the tariff will take place on April 2nd, 2025, Liberation Day in America, in caps. Please let this notification serve to represent that the Department of Homeland Security, Border Patrol, and other law enforcement agencies within our country have been so notified. Thank you for your attention to this matter. He put Liberation Day in America in bold here. I mean, I think the markets may get a little excited about some of the terminology that's being thrown out there, but kind of still underplaying what this could look like. Now, if you go ahead and ask Grok, who buys the most Venezuelan oil and gas, it used to be the United States, but after 2019, that trade was dramatically cut. So we don't really buy anything from Venezuela as far as oil and natural gas. But China has become a top destination, taking in 350,000 barrels per day. Often through indirect channels despite sanctions. India has also increased purchases, hitting over 63,000 barrels per day in 2024, up from almost nothing the prior year. European countries like Spain and Repsol, operating under U.S. licenses, have ramped up imports. As Europe as a whole has taken in about 75,000 barrels per day last year. Cuba remains a smaller but consistent buyer. Brazil and Turkey also feature in trade data, often buying through intermediaries. So you're looking at parts of Europe, China, India, parts of South America. If Trump's serious about this, then this would be huge in terms of who gets tariffed and how much gets tariffed. If you're talking about putting another 25% on China, that's not something that Wall Street really paid attention to today. So they're only taking what they want to hear seriously, which, is kind of one of those things that should make you a little nervous. But I do have to say, look at this bounce on the SPY. You gapped up today from Friday's close, which you were roughly at about 564. You gapped up today, opened the day at 570.82, which was above the 200-day moving average. You came down a little bit in the beginning of trading. You found support right at literally like on the almost on the penny, right, of your 200-day moving average. You actually hit the low of the day at $570.20. The 200-day moving average is at 570.02, so 18 cents above your 200-day moving average. Found support there and then ripped higher throughout the day. That is about as textbook, technical, bullish breakout that you can get, right? That's about as good as you'll ever see. So it does suggest we could get further upside from here. And again, that's possible. I think this is probably just the first down move of a longer trend of moving lower. Again, because I don't think this tariff thing is going away anytime soon. And it's really not about the inflation story. It's about the damage that this could do to the economy. It is no exaggeration when people say the Smoot-Hawley Act, Tariff Act of 1930 caused the Great Depression. Like, are we going to get a Great Depression this time around because of tariffs? No. Okay, no. Could we see a recession? Absolutely. And we're really not pricing in a recession at all to markets. Definitely not like an average style recession. You're at best pricing in a little bit of a slowdown to growth, but nowhere close to recession. Now, what did get the markets a little bit excited today was the economic data. Okay, so you had Chicago Fed National Activity Index that came in better than expected at 0.18. The estimate was 0.08, and last month was negative 0.08. So that was a little bit better than expected. Not really a huge deal. But it was this soft data here with S&P Global Composite PMI, Manufacturing PMI, and Services PMI. So the Composite PMI came in better than expected. Came in at 53.5 after hitting a 10-month low in February of 51.6. So that was, definitely positive. It says this indicates the strongest growth since December of 2024. A flash estimate showed the service sector led the upturn, with some of the growth attributed to a recovery in business activity following weather-related disruptions in January and February. Meanwhile, manufacturing PMIs fell to 49.8 versus 52.7. After a tariff-driven boost earlier in the year. Employment grew only marginally, recovering from February's decline. Input price inflation surged to a 2-year high, especially in manufacturing due to tariffs, though competition limited the pass-through to selling prices. And I think Wall Street kind of likes that as well. You're seeing business input costs moving higher, but they're not really passing that through to selling prices because of some of the demand issues. It says businesses' expectations for the year ahead dropped to their second lowest since October 2022. That's not good. Let me say that again. Businesses' expectations for the year ahead dropped to their second lowest since October of 2022, reflecting growing caution due to demand concerns and Trump's administration's policies. Okay, so there is some good here, okay, but there is some like really bad things as well in this report. Let me say that a third time, okay, just to get the point across. Businesses' expectations for the year ahead dropped to their second lowest level since October of 2022, reflecting growing caution due to demand concerns and the Trump administration's policies. Yeah, Wall Street just is hearing what they want to hear today. And I think it was kind of in the air, per se, to get a bounce. People wanted to see a bounce. People were calling for a bounce, kind of a self-fulfilling prophecy in that regard. And could you bounce further from here? Of course you could. I think we really want to see how we react around the 575 level. If you can get above that 575 level, you could make a run to your 100-day moving average, which is around 589. But I don't think we're going back to new all-time highs anytime soon. And I think this will inevitably set us up for a move lower. And I think right now is a time to reduce risk in portfolios. As I've explained before, if we have a recession, you have 40% downside from here. If we don't have a recession, then I think all-time highs, maybe 6,200, could be in the cards by the end of this year. 6,200 from here is about 8% upside. I don't like that risk reward skew. It's not going to pay to be a bull here. Now, as I said in previous videos, you're going to get a lot of volatility this week, and you're going to have a lot of data this week. Even tomorrow, you're going to get Fed Kugler, S&P Case-Shiller home price year over year, house price index month over month, year over year. Fed Williams that speaks tomorrow. CB Consumer Confidence Index for March. New home sales for February. New home sales month over month. Richmond Fed Manufacturing Index. Richmond Fed Manufacturing Shipments. Richmond Fed Services Revenues. A 2-year bond auction. And even building permits that come out for February. All of that data coming out tomorrow. Now, most of this data is really just soft data. Doesn't tell you a whole lot. Besides new home sales, that's a little on the harder data side. This CB Consumer Confidence Survey will be very important as well, because confidence tends to kind of precede what happens in the overall economy. But it's the second half of this week where you have the hard data. And Jerome Powell made it very clear last week. The soft data is shit. The hard data is good. The question is, does that soft data kind of get fed through into the hard data, or does it not? Does it happen fast? Does it happen slow? Does it not happen at all? And that's why Jerome Powell essentially was kind of bullish last week, more nervous about the economy than nervous about inflation. He really downplayed the inflation risk and kind of emphasized the will to be flexible, even if there is a rise in inflation. So this hard data coming out in the second half of this week, starting on Wednesday, will be critically important. On Wednesday, you have durable goods orders month over month. Last month was positive 3.1%. A lot of people say, and that was for January, a lot of people think that was because of tariffs, the over ordering in anticipation of tariffs. Well, now you're expecting negative 1.2% for February. That number could be way worse than that, especially considering by all things that we can see, company earnings calls, data reports, sentiment surveys, demand has really been slowing down even further throughout February, throughout March. There's really been no stop to that in Q1. You could see durable goods orders fall sharply as maybe companies realized they over-ordered in anticipation of tariffs, and ultimately the can just got kicked down the road a little bit more, and there is growing inventories out there. Now, tomorrow Wednesday morning, you also get Fed Kashkari and Fed Musaliam that will be speaking, a 5-year bond auction as well. Now, on Thursday, you get GDP growth rate quarter over quarter, final number for Q4, initial jobless claims, the goods trades balance for February. That will feed into a new GDP estimate, which the Atlanta Fed GDP Now tracker is currently tracking at negative 1.8% GDP, which, again, the average estimate by economists is still about 1.6, 1.7% GDP for Q1. You are, again, nowhere near even pricing in a recession from that regard. Continuing on, Thursday, pending home sales month over month, year over year, bunch of bond auctions, and where is it? Kansas Fed Composite Index and the Manufacturing Index. Again, more soft data, but again, that is important kind of to judge what could be coming for the economy in the future. Soft data tends to kind of precede hard data. Now, on Friday, you have core PCE month over month. You have personal income and personal spending. Personal spending is by far the biggest catalyst of this week because spending is such a large portion of the economy. Last month in January, it was negative 0.2%. I think it probably is going to come in negative again. We have not had 2 consecutive months of negative personal spending since the shutdown of COVID. Okay, in that case, we had a 3 negative months in a row. But you have not had 2 negative months in a row since that shutdown. If we get a negative report here for Friday, yeah, Wall Street's not going to like that. Recession will become more of a talked about topic, and that would put downside pressure on stocks. So whatever happens leading into Friday, I don't think it really matters all too much, because once we get Friday's data, it's really going to be the end all be all, at least for now, on what's happening with the economy. Again, if personal spending comes in good, then you have maybe more of a relief rally to come. So it can go both ways here. I'm just not super confident that personal spending was good in February based on a lot of the earnings that we have heard so far from especially your retailers, Walmart, Target, Best Buy, Abercrombie, Nike, FedEx, like name the company, they're warning about the consumer. Dollar General, like they're all warning about the consumer. I don't think this is the time to take excessive risk in portfolios. But then again, that's just my opinion. Now, core PCE index will also be very important. We kind of have the inputs already, so we have a pretty good understanding of what this is going to look like. You're expecting around 0.3%, largely the same as last month. Here on the day today, the CNN Fear and Greed Index is coming in at 28. That is now in fear territory. You've been in extreme fear for the last couple of weeks, so it is a positive to see this moving out of extreme fear, now only in fear. Market momentum, extreme fear. Stock price strength, extreme fear. Stock price breadth, extreme fear. Put and call options, extreme fear. Market volatilities, neutral. Safe haven demand in extreme fear. And junk bond demand currently in extreme greed. So still across the board, things look pretty weak, but improving a little bit. The percentage of stocks trading above their 50-day moving average coming in at 32.66%, up about 4% today. And, well, for the bull case here, most of the market is still well below its 50-day moving average. So there is room for a recovery here. It just depends what happens in the overall economy. Same is true for sentiment. For the past month, you have had essentially less than 20% of investors bullish, 80% of investors or more, a little bit more some weeks, being neutral or bearish. When you only have 20% of people bullish in sentiment surveys, that tends to be a pretty good contrarian indicator that stocks do well. And normally that's true. If there's just, some one-off reason or something happening that causes people to get bearish. That's true. Usually it is a great buying opportunity. But if people are negative because of these events, but actually the economy could be weakening, could be starting to look more recessionary, that's the dynamic in which it may not be a good contrarian indicator to get bullish when people are bearish. But this is kind of like what we had in 2022, where you got the first drop, markets got oversold, people got very bearish. Okay, great. Well, you fell to almost your 300-day moving average, which is exactly what markets just did. And then you bounce back up to your 100-day moving average, almost your 50-day moving average. Then you came down and you hit a new low. But people didn't get, overly bearish, right? The RSI did not get oversold here, even though it was a new low. You bounce back up almost to, new highs by March. And then you absolutely crashed again to a new low. You bounced for a couple days, new low. You bounced for like 2 months, and then you crashed to the ultimate low. And then you started the uptrend higher, but still with a lot of chop. I think you're in the first drop phase right now, similar to what you had in 2022. Question is, do we go into a recession or not? If we go into a recession, you can make a case for 40% decline from here. If we don't go into a recession, you could make a case for 8 to 10% upside. So I just don't like the risk reward. And it makes sense why Warren Buffett has record levels of cash on the sidelines right now. The only way to capitalize on a potential recession or capitalize on severely depressed prices and markets is to have cash and be ready to buy when the opportunity presents itself. And even if you have to, miss some of the almost 2% up days like you see right now to gain greater clarity, to use the term from the Fed, to make an accurate, good business decision or equity allocation decision, that can make sense instead of putting yourself in a vulnerable position if we do have a recession to see some massive losses, theoretically, if you were all in this market. So right now, I'm staying invested, but I'm keeping as much cash as possible on the sidelines. I'm not as quick to buy these dips. And ultimately, what would make me more, bullish on the economy would be to start seeing some of the leading indicators tilting upwards again. Right now, all leading indicators, essentially all of them, are not good. Even the one today, like sure, the PMIs came in okay on the headline number. Under the surface, if you ask businesses in the service sector how they feel about the next 12 months, it's the second lowest reading since October of 2022, when everyone thought we were going into a recession. That's not super good, right? That's not a good sign. So even under the surface of some of this soft data, it doesn't sound great. And in this environment, I think the upside is way less than the potential downside. And I will make sure I am in a position to capitalize if we do see that downside. But it's a balancing act here, because you do not want to get out of all of your stocks, because then you wake up, a Tesla's up 10%, and maybe it never hits a new low again. Maybe, the fears of a recession are overblown out there, and stocks come roaring back. In that scenario, you don't want to miss the upside either. So it's kind of a balancing game right now, not being all out markets or not being all in markets, having flexibility to, go each way. Nonetheless, we do have some earnings this week as well, as we talked about in the last video. Today in after hours, you have Oklo and KB Homes. KB Homes obviously going to be the important one. Tomorrow, Rumble, McCormick in pre-market, GameStop in after hours, Wednesday pre-market, Dollar Tree, Chewy, Jinko, Paychex, and Cintas. Wednesday and after hours, Microvision, some other smaller names, Jeffries, which could be one to watch. Thursday, really, it's Lululemon in after hours. That is the big one. They cater to higher income consumers, which tend to drive spending in the economy in the vast majority. So is Lululemon doing okay? Are they slowing down? That's going to tell us more about the segment of the economy or the consumer that has really been driving the economy. So if Lululemon's customers slowing down even more, if they have negative things to say, that is not going to be a good sign for the broader economic trends. So let me know what you guys think about this down below in the comment section. Again, I do think markets could bounce a little bit more here, perhaps trade sideways for a period. Friday's going to be the big data. That's really, I mean, especially if we get a big surprise in either way, either a good surprise or a bad surprise, that's what's going to move the markets the most. Unfortunately, that data comes out on Friday, so we have to wait a while between now and then. Let me know what you guys think about this down below in the comment section. Do you think Trump is actually going to make some concessions for reciprocal tariffs, or do you think this is mostly just talk? Right? Do you think we're actually going to quote unquote have this Liberation Day in America, or is it going to be a very neutered version of what is kind of out there right now? Just one-off countries, maybe Iran, maybe a little bit of China, maybe a little bit of Canada, and maybe a little bit of Europe, but not really like blanket tariffs. Again, I don't know, but it does seem like Trump has been talking a big game, and to really walk back now doesn't make a whole lot of sense, just to me personally. Let me know what you guys think about this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.